This is a production of the Michael Parsons Trading Institute. All rights are reserved. No duplication or distribution is permitted without written authorization. Michael Parsons Trading Institute presents Balanced Dynamics, the video series. Disclaimer required by the CFTC: the trading of any financial instrument is risky and can cause substantial loss, including the trading of futures, stocks, mutual funds, or options. The use of stops may not limit losses to the intended amounts. Only risk capital should be used to trade futures, stocks, or options on futures or stocks, or mutual funds, or any other financial instruments, whether in conjunction with this product or otherwise. All investments and trades carry risk, and you ultimately make all trading decisions, and you are solely and individually responsible for the decisions and the results of those decisions. Past performance is not indicative of the future results. Not all trades were executed in the actual markets, and the impact of the results can be over or understated. The results and sources are believed to be reliable, but no assurance is made for accuracy or completeness, and is subject to change without notice. You must be aware of the risk and be willing to accept them in order to invest in any financial instrument, regardless of the market. Don't trade with money you can't afford to lose. This is neither a solicitation nor an offer to buy, sell any financial instrument. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed in any of our trading materials or websites. In other words, if you risk it, you can lose it. Balanced Dynamics, video number 4, Advanced Price Targeting Concepts. Price targets also provide a timing factor. While we caution that this is not a timing method, the fact is that most targets are made within a certain balanced time. If all is equal, and the timing and volatility is the same, then typically what you will find is that the originating target point going through the balance point will result in a similar time from point A to point C. In other words, the time from the originating point to the balance point is oftentimes equal to that of from the balance point to the actual target. Equal time. This principle is useful in determining whether or not a target has come in, and when you can expect it to arrive. It is, however, a guide and not a firm factor, because there are issues in regard to volatility and market bias that can impact this timing. If we go to a chart of gold on the daily time frame, we can see a couple of examples of how this works. If we would take a originating point and go through the balance point, as we see through here, we end up with our target, as we can see up here. The timing factor can be determined very easily with any type of cycle tool that can be spread across and used to help facilitate the actual timing, or you can simply count the bars. And you can see that starting with our originating point, using the balance point as a central location, we end up with the timing of the actual target. Well, this is quite useful because it gives you an idea as to when you can expect the actual target to arrive, which is very valuable, particularly if you trade options. But for other purposes, it serves also to determine whether the target has come in. Sometimes a target comes up short. Well, is it already too late for it? Well, knowing the timing helps you to determine whether this is the case or not. Another example we can look at simply going across from another point, for example this point, through this balance point, which gives us the target that we see right here, the small point where it hesitates and moves back up. If we look at the timing again, using the very same method, balancing it out with the central point found in the balance point, we end up with our time once again right on target. Now that doesn't mean it's always going to work this way. We're going to look at a couple of examples where there are some issues that you'll have to address and take in consideration when using this method of timing. Now one important factor that will impact the timing is that of volatility. And we can see this if we take another target within gold and use it through a balance point. As we see here, we end up with a target clearly here. There are a couple of things that stand out when you look at this, particularly if you refer back to the information that we've discussed in regard to volatility. One thing is that we have quite a volatile action just before this target came in. You can see how fast these bars move as compared to the majority that we see within the chart. Secondly, we also see how deeply this actually exceeded or passed the target line before it reacted, thereby establishing or implying strongly that volatility was high. These factors of volatility do impact, of course, the timing. How so? Well, let's find out exactly what the timing should have been by using a cycle tool. And what we find is that the timing was really indicated way out here. Obviously, it came in a whole lot earlier than anticipated. Why? Well, as volatility increases, then the actual time that it takes to reach a target will be lessened. If volatility is reduced or declines, then it'll take longer to come in. What we have to consider is the fact that the first half establishes the boundaries or the rules for the entire target. If at following the balance point, the market increases how fast it moves, well then the target will come in earlier. If it slows down, well then the target will come in later. If it is equal in volatility and other factors, well then the timing will be approximately the same, if not exactly so. This is how it works in regard to volatility. An increase in volatility on the latter half will mean your target arrives sooner. A reduction of volatility in the second half would mean that the target would take longer to arrive. An obvious situation where you will have, because of lack of volatility, a price target reached is that of a long drawn-out consolidation, as we see here in the S&P E-mini on a 15-minute time frame. Now this pattern is itself very long, very drawn out, but it's not difficult to locate exactly where the balance point is. In fact, we have a gap right there. But when we use a target line, what we end up with is a situation where price never actually touches it. It's just too far away. And it's not that it didn't try or reach far enough, it just took too long to actually make the move. In fact, when we do this mathematically, what we end up with is actually a perfect target. So obviously the target was correct. So the approach in this case was best served mathematically rather than using a target line. But this is an important point when you see a long, drawn-out, unusually delayed consolidation pattern that is narrow, like you see in this pattern here. Expect the time to be delayed and your target, well, to not come in quite as anticipated. What was the actual time expected for this target? Well, using a cycle tool, we can determine that it's actually right at this point. And we can see how early that time was compared to the actual high of the market. Quite a bit of difference. So when you see a long drawn-out consolidation, expect a delay in your target. Each balance point is an intricate part of the waves that exist in the market. And it's not uncommon to have one single solitary balance point have multiple targets running through it. How so? Well, take a look at this diagram that we have and look at the balance point that we have here. Each succeeding high or low prior to that balance point oftentimes has a similar number highs and lows target opposite it. In this case, we have multiple lows prior to the balance point. This low targets this high. This low targets this high. The fact that we have this natural phenomenon of multiple targets occurring through single solitary balance points is useful in the fact that it provides us a basis for knowing what multiple swings will exist or what are due, thereby giving us the ability to forecast what we can expect not just in one swing, but in multiple swings in the future. The rule, though, in regarding multiple targets to a single solitary balance point follows that they must remain in sequence. For example, the closest low that occurs prior to the balance point will have its target come first, following the balance point. The one furthest out from the occurrence of the balance point, or actually the very first point or low or high that occurred, would in fact be the last high or low occurring after the balance point. Once we simply follow these rules, the rest becomes easy, and using one single solitary balance point to target multiple targets. An additional benefit that comes with multiple targets running through a single solitary balance point is that of verification. Now, realistically, in a real market situation, you may end up with situations that have multiple choices that you may be looking at as potential balance points. Or you may have a market that's skewed as a result of market volatility or market bias. What do you do then? Well, typically, if you have multiple targets running through a single solitary area, then you have the opportunity to take the closest endpoints and utilize them as verification. For example, in this case, taking this low and verifying with this high. The result is that you verify the actual balance point, eliminating any other choices. This allows you to take the furthest points and their targets and to be able to target them much more accurately, thereby increasing the benefit and the accuracy of the technique. Looking at the market of gold on a daily time frame, let's take a few things that we've learned and apply it in a real market. Now, looking at this, we want to focus in on these 2 points that we see out here. We have multiple points and multiple potential targets. As we look at this swing, which we have to pass through, we have to find a balance point and use these points, originating points, through the balance point to determine the actual target. Now, looking at this, the first choice that I would normally take is actually right here. And there's a reason for that. There's a nice wide stance in here. There's a doji bar, though I have the bars compressed in order to see enough data to see these points. And you can't see it as clear. If you look closely, you can see that there's a doji bar there. There's a high targeting a low here, and it has a wide stance. So it makes for change even here, where you can see that the actual trend is changing in this area from a certain pace to an accelerated pace. And so this looks like it would be the likely choice to use as a balance point. But there's a problem with that. If you look at the market and you take this high and you run it through that point, well, what do you see? Well, here's our first point that comes in out here. And you can see how far off it is from this target line. Now, the 2 factors here that we want to bear in mind, according to what we've learned so far. 1, we have multiple targets. So we have a secondary target that we should be looking at here. And 2, well, we're not quite ending up as we should on a balanced line as we see here. Now, for trade management, we can use anything, including a simple trend line, to determine a point to get out and lock in our profits. So there's a number of trade management factors that we can use. What we need to know is approximately how far this market is going to go and simply keep a stop moving in line with it. But looking at this, obviously there's something different. And so can we take advantage of that in order to get a more accurate target for our second point? Well, the answer is yes. When we move this target line, we find that we end up with our target somewhere around here. And you can see that what matches is actually this point where we have a bar split right here, which also has a high and low targeting itself. So even though originally even I would tend to lean toward this point as a balance point, the reality is that obviously this is either A, this is what it originally was, or B, because of market bias or some other factor, it has skewed and has moved higher. Thereby, I can use this point, now verified with the first target in place, for the second point. And so I can go back here, taking the prior high, and run it right through that point, and we end up with a target line. Now, looking past this first target, what do we see? Well, we see this point come in right here. And so our target is met beautifully as expected, based on the verification that we had with a prior target. And you can see that it's because the market's biased in one direction. You can see how far it's moving and how strongly it's moving to the upside. The market bias is really what has skewed this market and shifted the balance point. But the fact is that A, we do have multiple targets to work with here. And so knowing that gives us an opportunity to take advantage or enter the market really at the best possible point when it reaches down here. Secondly, we know that based on the first target that it's not quite where we originally thought, so we needed to make a shift in where our target line or balance point would be located at, and that is up here. Doing so with the first point verified for the second point to give us a more accurate entry. And of course a very profitable one, as you can see here. Another wonderful phenomenon in regard to balance points is the fact that typically you'll have multiple target sources targeting the same location, thereby verifying the price level. An example can be seen in this illustration. Here we have a balance point right here, and we also have a smaller balance point right here. With this originating point, we are targeted up to this level. With this balance point, we are also targeted at this level and know that we have verification by two sources of where the price level will go, thereby giving us an opportunity for more accurate and more confident trade in relation to the price targeted. Going back to our gold chart, let's see how we can use this principle of multiple target sources to our advantage. Now this is the same gold chart, but I've expanded a little bit, and this was the secondary point that we use or we verified in the last view of this chart. And so this is where we were looking at a buy opportunity for the market to go higher. As you can see, the market rose higher, strong, and then swung back down close to but higher than our buy point, and then continued higher. Is there some way to take advantage of these swings and the targets? Well, for example, how would we know the lock-in profits here? Well, let's take a look at this from a couple of approaches. First off, we have the swing downward here, and you'll note that we have this swing back, a contrary pattern here, that would create support for any target line. Just before it, we also see a bar split right here that clearly stands out and is a great place to place a target line. So we have this first off to work with. So let's use our target line right through this point, and we end up with something like this. And we can also look at the swing as it's rising here and see if we can find a balance point. Now we have a contrary swing here, we have one here. If we look between them, there's a doji bar right here that this market also finds or uses as support after it finishes this contrary swing. So it's using it as a horizontal support before moving higher. So this would be a natural point also for a balance point. Now we can't run a target line through this as we did with the others because, well, we've got a lot of bars to cross through and it doesn't quite work that way. But we can use another tool, for example a Fibonacci tool or any other mathematical basis, and doubling the level that you're looking at, and we end up with something like this at 527.9 or somewhere in that vicinity. But you'll note that when price comes up and hits this area, it basically hits both these at the same time. And so we have two multiple target sources that give us the same price area or target level. Now this is a way that you can use to verify the price level. And this applies a number of ways. Even the short swing that we see here, we have a long bar here which is stronger than most and can also be used simply by splitting that, as we talked earlier about how to use it as a balance point, and we end up with a similar situation. Now it ends up a little higher, but certainly even better than what we had with the other two price levels for an exit. Either way, we still have verification of the same general area. And this is very useful to verify a price target area as a point for taking profits or entering in the market. One of the beautiful aspects of this technique that shows the power of it is the ability to predict multiple swings. Now this sounds like it would be rather difficult, but in reality it's nothing more than an extension of what we've already learned. Take a look at this diagram for a moment. And price established already in red. Let's say we're looking at a buy opportunity right here. We know approximately how far price will go because we already have a target establishing the price level. That price level, well, should have a balance point somewhere in the center between the low that we just started from and the high or price level that we expect. So mathematically, we can actually calculate the approximate level of the balance point. Once we do that, we can take the prior high or low before it, in this case a high, and use it to target the next following point. Even though we don't have this high actually in just yet, and there will be variables, we can have an idea of the approximate level of the price that we'll swing back to, and thereby setting up the next potential swing. That in turn can be used to calculate the next price level, because between these two should also be another balance point that we can take a prior high or low and use to actually target the next point. Do you see how it works? It's a simple matter of mathematically extending each swing as long as the pattern remains intact. Once an inverse occurs or some other variable, well then adjustments will be required. But until they do, you will find that the odds favor these swings following in order and in sequence over and over again. Thereby you can have already calculated and predicted not just one swing, but several swings. Imagine for a moment being able to calculate from this point that the market will move not only to here, but down here, and then back up here again. What a profitable opportunity that will allow you. Applying the principles of determining multiple swings in a real market is really rather simple. Here we're looking at a long-term chart. This happens to be the euro against the US dollar on the monthly time frame, so we're looking at a pretty large scale. But you can see already in this view that we have what looks like a balance point that's formed in a swing where the market's making an up move. The question is, well, how far is it going to go up? And how far is it going to come back down? And where's it going to go in the next set of swings? And how can we anticipate that? Well, based on what's an obvious balance point here, we can take a view of this, and we'll do this on a conservative basis, and use a balance point. And it looks like we're right about at that level. Now, we also have a doji bar, so the anticipation would be at this point that the market would turn around, unless it's inversing, it would turn around and drop. How far would it drop? Well, let's determine that. Based on this location, we can determine that this should be a halfway point or targeting from this prior high. Now, we're just going to use the mathematical approach in all these swings to keep them in unison, but basically it would be something like this. So we would be looking for the market to come down here to this level at 1.07. How long will it take? Well, while not precise, we can take, again, another tool, a cycle tool, and scan it across and get an approximate time where we would expect it to occur. Now, we set the center right where the balance point is because that's where we would be targeting through, and we can set a target right at this level, approximately right here, where it intersects at this price level that we've already determined and the time that we would expect it to come in. Now, having done that, that leaves us with a projected price and time for when this market and where this market will go. Can we take it further? Well, yes, of course we can. The next step is that we now have this high and this predicted price low. So what can we do with that? Well, we simply take a projection of the price, and we're going to be a little conservative because this looks like some of the highs are in place. Avoid some of the spikes here. And we now have a halfway point of right here, this level 1.1897. Halfway, or time-wise, between this point and this predicted point and where we are currently at is somewhere in between here. So time-wise, we can take a projection which would come from this prior low and take it across and separate it, put it right in between these 2 points. And I'm going to just estimate. We're not going to go with preciseness here, just because we're just establishing the principle. And we can see that, it's about halfway point, so that puts the time about here at this point. And our price level would be whatever we can project from this low through here to the next point. So I'm going to have to bring this down a little bit, and we're going to take this next thing. We're going to avoid the spikes again, and we're going to go across. And you note that I take this up so that it's a halfway, at the very halfway point of the prior swing. And that gives a projection of this price level 1.916. So, and the time, of course, that we've projected at this time. So we have two corresponding points at about right here. Now, in case you missed what I said, just to reemphasize, we'll just go through. All I did was see the determine the difference between these two levels as a center point right here, thereby taking this price projection from this low and also centering it right here to give me this price level as we see up here. Time-wise, all I'm doing is taking the difference in time between this point and this projected low and dividing it and using it from where we would project a line or target line through. And so we're doubling that as well, giving us a time right here of this price level. So it's a geometric setup where we're determining the point and price that we would expect for the price to go and when we would expect it to arrive. Now, let's take it one more step. And we're now looking at this low and this high. So we can take, again, a projection of a halfway point as we see here. Now we have this high that will be projected through here. So we also need a time point, and I don't have this quite centered, but so let me get this at a correct time price level or separation. And we're also looking at a time factor, which would be from somewhere in this high through this point, or these 2 points, which would be in between the time between this low and this high, and that gives us a projection of right here. So we're looking at these two projections. Now all we have to do is have a price level where we're taking it from this price level up here through here and project it downward for what the low would be. So in case you're confused, it basically boils down to that we are using a prior low, and we're finding the halfway point between this point and this point, time-wise, as we see here, and price-wise, as we see here. And we're projecting this based on our prior high, which would be projecting through this to give us our low, which would be right here. These two gives us the intersecting point, as we see right here. And so this is where we would expect price to come in at about an approximate time. Now, the fact is that we are not going to be 100% accurate in this. And as price moves and develops, we would refine where those projections would be. But we now have a basic idea, concept, that price is going to come down to here, move up to here, and then come back down to here, and no doubt bounce off of that and go higher. So what does price do? Well, let's come back and see what happens. As we return, when we look at the price levels and how the market developed, you can see how well the projections worked. In this case, price tended to come in a little earlier in all cases, but not that much earlier than what was indicated. The price level, as you can see in most cases, was pretty accurate in its determination of the price level. And this is an example of how we would determine it. Now, bear in mind that as these price swings develop, you have the opportunity to refine these price levels. And that's what you would do as the market progresses. But you're able to, by means of the method and technique, to actually project multiple swings. And you can use that to your advantage in determining the best trades and the best approach to your trading. And it's as simple as we can see right here. Multiple time frames. There is a clear advantage to having a different view, a different perspective of anything you look at, and that's true when it comes to trading the markets. And it actually overflows over to our targeting as well. The fact is, having a different view will prove profitable, much more profitable, if you take advantage of it. Now, what do we mean by that? Well, there's 4 items that we're going to summarize here. We're going to talk about them individually in a little bit here. But let's summarize these points and get the basic concept. First off, larger targets empower smaller targets. Now, what do we mean by that? Well, basically, it boils down to this. Let's say you're trading a daily time frame. If you look at a monthly target and you see that the monthly target indicates the market's going higher, what are you going to do better as, buying or selling on a daily time frame? Well, obviously buying, because that's what the monthly chart indicates. So when you see a monthly target indicating a higher move or swing, looking at the daily, obviously you're going to have moves or swings indicating targets higher and lower. When the target begins to develop or start to rise, then obviously the buying opportunity should prove to be more profitable than trying to attempt to trade against it by selling. So use the larger targets to empower your smaller targets. The second issue is that smaller targets should be used to refine your entries on the larger targets. Now this applies in a couple of different approaches. Obviously, if you're trading the daily, you're going to use a daily time frame to refine any entry, even if you're using the monthly to get a better perspective of where the strongest swings are. But you also have the opportunity to go down a little lower. If you're trading the daily, oftentimes, even though you're not looking at the market every single day or throughout the day, often you can use the hourly charts to refine that entry and exit for your trades that you would actually be doing on the daily time frame. The third issue is that larger targets warn of stronger swings, and they should most definitely be respected. If you are looking at a swing that is completed on a larger scale, don't try to squeeze every little ounce of profit out of that swing. Even though the daily time frame or lower time frame may be indicating that you might be able to get another swing out of it, because somewhere along the line a target's going to come up short and the market's going to inverse in the opposite direction, and you can get yourself in trouble. So respect those larger targets, because they are much stronger. When they've been met, then expect a change. Don't force the last little bit or last ounce of juice out of that trade. The fourth item is that the smaller targets give early warning of change. When a market has reached a target, well, the smaller targets would tend to give indications through missing a target, for example, indication of bias in one direction or another, a change in volatility. These smaller targets can be a great way to give you early warning when it's time to take action to take advantage of a larger scale trade. Even if you're trading the daily, if you see an hourly not meeting its target and changing or biasing in a specific direction, even though it's not showing up on the daily time frame of which you're trading, you still can take advantage of that early warning and know when it's time to enter or exit a trade. If we're trading a market such as gold on the daily time frame, then by going to a time frame such as this weekly view, we should see a better view of what we can expect out of the market. In this particular market, you can see where it's moved in an upswing and then consolidated for a while. The actual setup of this market lends itself for higher move. Why do we say that? Well, we have a balance point sitting right here, and we have a low and a high bordering that, giving us a target or target line that would be something like this. Obviously, we're looking at a pretty good move that we can take advantage of. The question is, how far will this market come back? Again, looking at the market overall, we can see that there's a balance point on this particular swing right here, and that this in turn has a couple of highs and a low to border it, giving it a target line for any prior highs. Now we have one high sitting right here that goes through this balance point, and we can confirm its location based on this low that came in. If we look back further and see or utilize the prior high, we can see that no matter where we place this target line, whether where we have it now or even lower, the fact remains that the second point, well, it's come in a little short, meaning that the market is already strongly biasing itself to the upside. This is the time that we really would need to seriously look at buying this market on the daily time frame to take advantage of the upcoming swing. Therefore, we would be looking at or returning back to a daily time frame to locate a buy opportunity to take advantage of this long-term swing. On the daily time frame, there's a couple of things that have become quite obvious when we look at the market's activity. Here we see the market had been declining, broke higher very strongly, declined sharply, so volatility is starting to show signs of increasing in this area, and had developed a consolidation pattern as we see here. The question is, what would it do at this point? Well, looking at this, we could look at some targets that are in place and see how we could take advantage of those targets. Some obvious things that stand out when we look at this pattern is that when we look at the balance point, we see a pattern right here. And when we consider the market's activity, as we see here or here, the indication is that the market should be moving down a little lower than what it has. First off, it hit this target, as we see here, but it also has a lower target line. Unless it's already showing a strong bias to the upside, then we should be seeing a lower move. As it stands, because of the consolidation, the market's very easy to buy on a breakout if one occurs, simply by using a trend line. But if we have the decline as expected on the target, we may be able to get a better situation and a better profit opportunity, because if it's lower and it moves higher, then obviously we'd stand to make more money. To accomplish that, we need to look at some balanced targets in regard to what's happening here. And there is in fact a balanced target right through this point that we see here. That means that we can actually target the high down lower, as we see right here. We also can do this mathematically by simply taking this, and based on what we're seeing here, we should see at least a move down to 670, if not more. Because of the proximity of the target line, we would expect the price to come down anywhere between this target line and this price level that we see here. So anywhere within this area would be an expected move. Well, let's take a look to see what happens on the next day to find out where we would be looking at a buy opportunity. When we return, you can see that the market declined very rapidly, as we see here. This actually reaches our target levels that we were looking at in regard to either this way or the other target line, as we see here. So we are at the area where we would expect to make a buy and take advantage of the larger swing. But we can go a step further. Now that we're down in this area, is it possible to slip down to a lower time frame, even if we are trading the daily? Well, the answer is yes. For example, the hourly chart tends to be a little bit longer than most people realize, lasting a couple of days. So the targets enable you as a trader to still trade them, even though you might be trading the daily time frame. Let's take a look at this in just a moment on the hourly time frame. As we move down to the hourly time frame, we'll look at the day in question, which is right here. It's rather easy to locate the balance point because it is this long bar that we see right here. We have a certain momentum. The market picks up pace rather rapidly. And we have a bar sitting basically by itself. Clear, open area in the bar with no overlap. And so it makes it easy to locate. But in addition to that, we also have a couple of other things. For example, we have a high that targets, a low targeting high over here. There's another one that targets over here, and so on and so on. So it's not difficult. Of course, the further time goes on, the less of the buy opportunity you have. But even with the price move itself, it was real easy to locate this balance point. Going back and simply taking a high and following the rules that we establish, when you have a long bar as a balance point, then you simply take a halfway point of that bar and use it as your balance point. And we end up somewhere around 661 to 662 area. And as you can see from price, it's a great buy opportunity. The market continued to move higher. If you missed that, well, here's the day that as it ended right here. And this started a new day over here. This new day also had an opportunity with a couple of balance points. We saw a development of a pattern here, but at minimum, perhaps you might set a better price, perhaps 664 or better, closer to the 661, And if you get a buy opportunity, great. If not, then you can wait for another buy opportunity if it should set up on the daily time frame. In any event, you're within the vicinity, because if we take this off and we turn it to a daily chart, this is what we see. This is the day in question right here, and you can see how the market moved higher. The price level that we were looking at approximately 662, was down in this vicinity at 662 or better. So obviously that was a great buy opportunity, and all we did was take or move down to the hourly time frame to target it. Now, you can't, unless you're trading intraday, go all the way down to a 10-minute or 1 minute to refine it that far. But if you have opportunity and you are trading and watching the market while it's actually trading, then there's nothing to prevent you from going down further and further and further to refine it all the way. By simply managing the trade at this point, you're looking at a substantial gain. On a weekly scale and the daily scale, both are very profitable. In the longer term, the market continues higher for quite some time on the daily time frame, as we see here, and it turns out to be a great trade, a great buy or entry point. And really, this is how simple it is. You're looking for the more stronger swings, the more stronger profit potential on a higher time frame than what you're trading. And then you're using that information and going to the time frame you're trading and finding the point to make an entry or an exit. And if you can, move down a little lower to refine that trade a little bit more. It's not necessary to move lower, but obviously if you have the opportunity to do so, then by all means do so. But this is how we take advantage of multiple time frames in order to enhance the trades and empower them. One other important aspect that we want to mention in regard to multiple time frames is that of using smaller time frames to give you early warning of trend changes and changes in market condition. An example can be seen, again, looking at gold, and if you look at this particular day, November the 8th, 2007, you can see where we topped out. Now, currently it's just in a consolidation. Whether it's going to move lower or higher is really irrelevant for the fact that the momentum that we once had came to an end and consolidated. And certainly, if you were a trader who's a very short-term trader, you would not want to sit here idly waiting for the market to make a move. But how would you know that a change is occurring? What are some of the signs that we would find? Well, if we go to the hourly, for example, and look at some of the changes, we can see how apparent they become. On the hourly time frame, we see a number of aspects occurring in regard to targets. For example, here we have a balance point, and when we target off of the prior originating point, we find a couple of things. For one, we're a little short right here. And that's not all. We can take another point and run through it, and we can see that again we're short in regard to hitting the target line. Yet we go the opposite direction, and what do we see? We go through a balance point here, and we see that the target is actually hit right here, indicating that the market is starting to bias to the downside and is starting to drift off of the upside targets. Later on, the market begins to consolidate and the targets become much more compressed. But the indication here, where the target fails in one direction and still is met in the opposite, makes it clear the indication that the market is now no longer an upward momentum. At minimum, it's a sideways momentum, but may even possibly be a declining momentum. The thing to do at this point is, in fact, look at the market and see what other analysis needs to be done, what other changes are occurring. And there's some obvious things that occur, for example, a low that is lower than a prior low, highs that fail to exceed prior highs. Obviously the market is changing. But the confirmation of the balance points gives you an opportunity to know, by means of an early warning, what's happening. The key is, though, is that you simply can't look at this based on just the time frame you're trading, because it takes time for these targets to develop. And by then, well, then it may be a little too late to take advantage of it. Therefore, if you go down to lower time frames, then you see much more. Here's the same market, but we've gone down a little lower to the 10-minute time frame. And what do we see? Well, we do see the target still being met, as we see here, and as we see here. But the one thing that we also note is that as these targets set up, it's clear that the actual high or low is different than prior activity. It's very clear early on, for example, that this particular target at this point, once this market begins to drop, is going to move lower than the prior low, indicating at this point that we definitely have a situation where the market's changing direction. The same thing is true with this target. As the market proceeds to move higher, we already know that the target is really set lower than a prior high. You see, we already have some indication that the market has now changed direction. And this is one of the key elements you want to look at. Where do the highs and lows position themselves, particularly in relation to prior highs and lows? On the time frame that you're trading, this may take time to develop, but on the lower time frames, they will actually give themselves away on a much earlier perspective, giving you an opportunity to have an early warning and an opportunity to plan your trade. Balanced Dynamics video number 4, Advanced Price Targeting Concepts. All methods and techniques are those developed by Michael J. Parsons. The videos are narrated by Michael J. Parsons. Director of Marketing, Osman Musa. Technical support, Melissa R. Parsons. Accounting, Ray B. Parsons. And translation, Heather L. Parsons. This is a production of the Michael Parsons Trading Institute. All rights are reserved. No duplication or distribution is permitted without written authorization.